Okay, let's talk mean reversion trading. You know, most of the time the market is not in a trend. If it is in a trend, it does it and then it mean reverts. And this is generally the cornerstone of most trading strategies. Now, there are strategies, of course, to get on board trends, breakouts, that kind of thing. However, I think using mean reversion, and regardless of the market you're in, and we'll talk a little bit in a second about the benefits of either market, but understanding how mean reversion plays a part as a trader can, if you don't necessarily use it as a strategy, it helps stop you getting into trades that are going to get you caught out. So the first thing is, let's look at a range bound market. So range bound market, fairly obvious. You've got some kind of a mean. Now, what do I mean by a mean? Now, that could be anything from a moving average, a VWAP, volume weighted average price. It could be a key level like the open, the close, a pivot point, something, some key price level, some support resistance level. You look on a daily chart, for example, often you see a price oscillating around a very key level. It goes up a little bit above it for a few days and comes down a bit. So anything that you can eyeball on the chart and say, you know what, price isn't getting too far away from that level, whether that is, like I say, an average that's consistently moving or if it's a fixed point. So that is what I mean by mean reversion. And what is the reversion part of it? That is taking the trade outside in. So in other words, you're waiting for the move away from the mean. You think it's enough, it's stretched enough, you think that's that run out of puff, and you're waiting for the spring to contract again and come back to that kind of midpoint. And if you imagine a Bollinger Band, that's kind of what we're looking for, although we're not using a Bollinger Band, that's kind of what we're looking for. The extension, the stretch, oh, that's a little bit too far and come back in, as opposed to an inside out strategy, which is waiting for the market to come back to the mean and then predicting the direction it's going to go away from the mean. So two distinct different strategies, but let's talk about the mean reversion one today. So if you're in a range bound environment, that is by far the best, generally speaking, for a mean reversion strategy, because the market is in itself mean reverting. It's moving up, it's moving down, it's moving up, it's moving down. So how can you time that? Well, the first thing is you're looking for the buying or selling to shut off. So that could be, it comes up to a point volume and just sits there and just starts to roll back over again. And then you take it for a pullback to the mean. Same, so basically you don't get involved in this point here. Anywhere close to the mean is a no-go zone because you're looking for extensions away from the mean. So you've got to be away from it, and then you need another reason to take the trade. So maybe that is a double top. Maybe that is resistance holding. Maybe you've spotted something on the tape. Maybe you get a little tiny flush up that fails and comes back lower, and then you can say, okay, I'm game on now. Quantify my risk. Let me look for a move back to the mean. So two things need to happen there. Extension away from the mean, and then a little strategy or setup at that price level that means you're going to come back into the mean. And the one little thing for me, which has always helped me loads with this, is always go further than you want to go. So the thing is with this kind of price action is it encourages you to get in early, because sometimes, you know, the price hasn't gone too far and it's come back to the mean. You think, I've missed that one. But actually, you're far better waiting for those real extensions that stretch, because they're going to come back far more aggressively. Yes, you might get caught on one that expands out the range. That's the way it is. So you've got to quantify your risk with it. But ultimately, you're looking for a little bit further move and then coming back in. A lot of people use scaling strategies for this as well. You've got to be a little bit cautious, but scaling in as it goes away from the mean, looking for it to come back in. But of course, obviously structuring your risk around the total number of scales, total size, and total adverse moves, so you don't get caught out. Support and resistance to hold, we talked about distance from a mean. I love this. I really, really like this one because it works so well, especially with something like the VWAP, which is the volume weighted average price on an intraday basis. You know, you see a pattern like this and you can say, well, the first move above it was 40 ticks away from the VWAP and we moved back. The low, okay, we've got to 35 ticks and we've pushed back. You then say, listen, this 35 to 45 ticks away from the VWAP is encouraging the other side of the trade to get involved. So logic from that is for the rest of the day, as soon as we get 30 to 50 ticks away from the VWAP, I'm going to look for something that is going to give me a clue that we are potentially going to revert back to the mean. So just looking at that, literally, physically, number of ticks away from a mean, and a VWAP is a very, very good one for that. Or it could be, like I say, a pivot point, a close, an open. It happens loads, but just seeing that actual literal tick value and saying, listen, we've come up to 40, down 40, we're up 40 again. Obviously that's enough for buyers not to be more interested in pushing it further. I'll have a go at it from a trade perspective. And the second one is trading on trends. Now, people are going to go, you don't play mean reversion strategy on trends. Yes, you must be very careful with it, because a trend day, if you're fading a trend, you're going to get nailed if you get it wrong. That's the way it is. But they can be very, very profitable if you're very, very patient and the trend has the right characteristics. What you don't want is a plodding, grinding, chugging trend. Just steer clear of those. They're just not worth the time from a mean reversion perspective, because you don't get that catalyst that is going to cause the reversion back to a mean. Now, if you're trading this, you're not looking for a full reversal. If you happen to get on one that does reverse and you pull your stop down and you get on the end of it, by all means, but that's never the goal. The goal is that you're looking for a pullback, again, to a moving average or to a VWAP or to some kind of more normal. So what are you looking for on this? You're looking for spikes. So this trending up, has a little spike up or a big spike up. Big flurry in volume will spike up. Time, very, very short period of time. A lot of move in a short period of time after a big move. That's kind of buyers just finishing off their order saying, get me in whatever cost. That's sellers who are stuck short, who can't take any more pain. But anyway, regardless of who it is, all that means is it's the last of the buyers for that time period. It's not to say you're not going to go above that high later on, but for that short time period, on a short time frame, if you see that sudden spike to the upside in volume and in price, the chances are it's going to come back. So trying to pick that sweet spot. Now that's very much a tape reading perspective. Of course, manage risk at all times, but understanding that you do get those spikes, you do get that urgency, and all you're doing is fading the guys who are emotional about their order flow, which is what it's all about. Flushes again to the downside. You see it as downside keeps going and going, and then you just get that absolute drive that just goes shoo, and flushes like 3 or 4 big, huge candles. That's when you go, okay, my risk reward, it's just moved 40 ticks in the last 4 minutes after a 150 point move, whatever it may be. That seems to me like we could have the end of the sellers for this next 15-minute period. Now I'll go in. But again, the key with this is timing it, is waiting to see last minute volatility expansion at the end of a trend. No point in the middle of a trend. The trend's already extreme. You've already got people saying they're going long, and then you want that last final flush that not only pulls the people out who are too early, but really gets rid of every single last person who ever thought it was a good idea to fade it. Then you step in. That's the key to that. I know it's easier said than done, but if you can nail those on the really big swinging days, those are the ones that are going to make you some money. But again, be cautious to manage risk. If you're too early on it, you get stopped out straight away. But that's why you got to be very strict with your stop on that and say, you know what, if I'm right, I'm right. If I'm wrong, I'm wrong. And I'll leave it and I'll reassess. The other one's a big candle. So kind of similar to this, where you've got that big candle, and that's just kind of quantifying what those are. So you've got your average 1 minute candle running at sort of 10, 15 ticks or whatever. Then all of a sudden you get a 30 tick one. Pay attention. End of a trend, big move, big extreme, last bit of stretch. That might be the time to get involved in a mean reversion. Again, like I say, you're not looking for a full reversal here. You're just looking for a pullback to some kind of moving average. Time of day. I've talked about time of day before, but very interestingly, if you go back and look at some of the charts for indices and even for your currencies, there's always patterns at specific times of day. Now, we had an instance where 3:30 on the FTSE would always get a turning point. There'd always be the spike and we'd get a turning point. Used to have a thing on the Dow where at midday US time would always be, if it's a trend day, the 15-minute window either side would be the high or low of it. So waiting and looking back and seeing if there's any evidence that there's a turning point. Same recently, we had a 4:30 turn on the US market. So Europe would close, it would go to an extreme, and then you'd find opposite buying or selling would come in, depending on whether you're up or down, and move the market the other way. So waiting for that for a mean reversion strategy. And if you can combine that with those, that's perfect. You wait for a spike or a flush into that noon time period or into that 4:30 time period, and then fade that. You're adding layers of edge onto your trade. And also the range, how far have we come? What's the range of the day so far? What's the range of the time period you're trading? And thinking, well, that's quite a lot already. If we go a little bit more as well, we're already in sort of unlikely territory. So maybe that's the time to use the spike, use the flush as a really fine tune my entry, but then think, well, the range is quite a lot. We're probably due a little bit of a pullback here. So 2 distinct different market environments, one type of strategy, but understanding the strengths of them both and where to deploy each of these techniques or each of these setups in the current market conditions or whichever market conditions you're looking at.